Christoph Eibl. He made headlines recently at an industry conference in Montreal where he said that gold will be, quote, annihilated. Do you care to explain that annihilation, Christoph?
Well, I agree. It's a pretty strong argument,
Yeah.
but bottom line is gold is a reflection of investors' demand. And obviously investors have a certain fear of the financial stability of the system itself, and that's why they're looking for alternatives. And gold is, in a way, more than 30% of the current production is just being demanded by investors, bullion demand, and so on and so forth. And the thing is, you will have days when, you know, that whole discussion about Greece, the discussion about US debt will in a way solve or find a solution. And then you'll find investors looking for alternatives again, for, you know, real production, real value, and real growth.
But we've already seen gold come off quite significantly. I mean, we were staring at $2,000 an ounce not long ago.
Right.
So how much will it drop when we do get some sort of solution, as you say, in Europe?
I mean, none of us has the glass ball in front of us, but bottom line is you've seen gold drop within only 3 days, more than $400. That tells you that gold is not built on solid rock, it's built on sand. It's built on, you know, investors that just, you know, are afraid of things. It's in a way a trade of desperation. And what we tend to feel is without investors' demand, gold would probably be trading somewhere $800, somewhere below $1,000, let's say. A lot of people would argue that the marginal costs of production are currently sitting somewhere at $1,200, which we feel will immediately go down with prices dropping, as there is economical production that can be, you know, mined at probably $800 and even $700. So the question mainly is, how long will fear determine and dominate the current market environment? And as long as this is the case, gold will still trade higher and gold will trade stable. But the thing is, you need to be prepared, because as you've seen, 3 days and the market dropped $400.
Right, so people are there because they see it as a safe haven investment. You're saying, watch out, it's going to fall. So where should they go? What else is safe?
Be opportunistic about it.
Okay.
Just about, you know, the gold market, be opportunistic about it. But, you know, there are metals that have fundamental scarcity, i.e. you have a deficit, like in some of the PGMs, like palladium, you have a deficit. Some of the base metals show real deficits, such as tin. Even copper shows a deficit. And you have a metal that is being needed in the industrial production. So, and these metals have come off more than 30%, some of them. So you have actually quite attractive entry levels, and at the same time commodities that are really scarce.
Would you go into copper right now? Is that what you're saying?
We tend to feel that copper at these levels, I mean, yesterday we've seen copper at 6,630.
14-month low.
That's like a 14-month low, as you said, and we tend to feel that it's quite attractive. I'm not sure if copper is the most attractive in the whole base metals complex, as we prefer probably tin and nickel, as they are very close to marginal cost of production. Copper is still quite far away from the marginal cost of production. But hence, if you look at the smaller base metals, you definitely find value these days.
Okay. Silver.
Silver, even more so than gold, is a reflection of investors' demand. And I mean, if you look at it today, you have around 30% of the annual supply. It shows you a surplus. So if you look at, I always bring up that little example. If you look at silver 2001, it was trading at $4, $4.20 an ounce, and there was a deficit in the market of around 10%. If you look at it today, you were trading more or less, say, $30. Shortly, you know, some time ago it was $42, and there's a surplus of 30%. So the question is, what am I getting wrong? I'm not getting anything wrong, because the fact is that investors are just picking up.
You got to look
consuming.
at the fundamentals,
Exactly.
is what you're saying as
Exactly.
well. Now, a funny trend, or is this a trend, I want to ask you, in Southeast Asia, where you have countries becoming more protectionist about tin production, for example?
Sure, like Indonesia, that's a very big, you know, that's actually a very good potential for upside prices. Like Indonesia saying we're not, you know, sending any material out of the country unless prices hit $25,000 a ton again. And the same might happen even in nickel, where, you know, just you have production being blown off the market because producers think they should get higher margins. And that's why probably the commodities that are closer to marginal costs of production are the ones that you want to buy as an investor, not necessarily the ones that are ridden, you know, by just investors' demand or by just pure speculation.
Very quickly, does it feel like 2008 again in the commodities markets?
Not at all. 2008 was a completely different picture. 2008, you had oversupply. The business cycle looked bad. We were heading into an economical downturn. Right now, we're just slowing down. There is no cyclical downturn, no recession.
We've got to leave it there on that positive note. Christoph Eibl there, founding partner and CEO of Tiberius.